The ITB, which is the home builders ETF, is up 1% year to date. The XLB, which is the S&P materials sector ETF, is up 1.9%. The Dow Transports, that index, is up 1.9%. Now, why am I beginning this week's presentation by giving the year-to-date returns of those ETFs and that index? Well, I had talked about them last month. I had pointed out that they are economically sensitive sectors or industries, and that they were doing very badly, and that this was perhaps a market signal that the US economy was going to slow down. In the case of the home builders, they were down in December almost 20% from their all-time high. The materials ETF and the Dow Transports were both down more than 10% from their all-time highs. Those highs were hit in October and November of last year. So we had a potential market signal last month that the US economy was going to slow down. But now here we see those indexes and ETFs outperforming. The greater market, the S&P 500, is down 1% year to date. So the market seems to be sending us a signal, if this continues, that the US economy isn't going to have any kind of severe slowdown for the next couple of months at least. Economic data tends to bear that out. We had the Atlanta Fed GDP now. The last time they updated it, it showed US GDP growth for the fourth quarter as being 2.7%. That is actually a slowdown from the third quarter GDP growth of 3.1%, but it still represents a very solid rate of growth. Now, solid economic growth is good for the stock markets in one way. It makes it easier for companies to grow their earnings. And in fact, when fourth quarter earnings begin to get reported, according to FactSet, they're saying that year-on-year earnings growth for the S&P 500 is going to be 11.7%. It may turn out that actual earnings aren't quite that good, but still, that's a sign of very strong earnings growth, and that's a big positive for the market. But on the other hand, coming off a period of high inflation, which we've just had, that strong economic growth means that inflation will be coming down less quickly. And that means that the Fed is going to be reluctant to cut rates. Currently, the Fed is pausing from a rate cutting cycle that it began in September. It's expected not to cut rates later this month and continue not to cut rates for a couple of more meetings going into the future. So basically, the strong growth helps with earnings but hurts with interest rate cuts. Now, you might ask, well, why is interest rate cuts so bad for the market? Well, if you think about what the short-term rate is, that's related to what longer-term interest rates are. And if you're investing in the stock market, you're kind of doing a balance between, well, what kind of earnings am I buying when I buy a stock to what kind of yield I'm getting when I'm buying a bond. And if you get higher bond yields, well, then that makes stocks relatively less attractive, and you would get the stock market to go down a little bit. So as the Fed has sort of announced that they're on pause, we've seen the 10-year Treasury yield go all the way up to 4.8%. It's just a little bit under 4.8% right now. If it goes above 4.8%, those would be the highest yields that we've seen since before the GFC. So the highest yields since, I think, 2007. So those are very high yields indeed, and that's certainly something that's going to pressure US stocks. Now, during this month, where the kind of sector in the S&P 500 that's sort of been struggling, and it's not doing all that terrible. I don't want to give the impression we're in some sort of bear market, but the sector that's been struggling is clearly the tech sector. Now, why should the tech sector be particularly sensitive to higher yields? Well, there's a fundamental explanation that people give to that. I hear it all the time, and sometimes I'm tempted to agree with it, but basically I don't buy it. It basically says, well, these are growth companies. So when you buy the stocks today in tech stocks, you're really buying their earnings in the future. And if you have higher yields, you use a higher discount rate to discount back those earnings to today. So they are more sensitive to higher bond yields. I don't really buy that. I think what's going on is simply that those stocks have gone up a lot. People are looking to reduce risk, and at the same time they're looking to reduce risk, they have the opportunity to shift into bonds, which are a heck of a lot more attractive today than they were earlier. Okay, I'm going to finish up by giving a little bit of discussion of what kind of information we have from the market coming out tonight. The first thing is the consumer price index for December will be released before the market opens tonight. If you remember back in December, we had a bad CPI number showing inflation was not dropping, and that really did cause a little bit of turmoil in the market and caused bond yields to drop. However, since then, we had a PCE number for November come out. That came out at the end of December. That was better than expected. And last night we had factory gate inflation, PPI, producer price index number. That was a little bit better than expected. So I think the market is hopeful that the CPI number is not going to be too bad. I think they're looking for something like a 3.3% year-on-year change in core. Once again, that kind of reminds you the Fed's not going to be cutting anytime soon with that because it's a long way from the Fed's target. But still, that's what the market's expecting. That would also be 0.2% month on month. If we get those numbers, I think the market will be broadly happy and we'll get stocks higher. But the fact, I think there's a little bit of optimism in the market. If we get a miss, I think we could have quite a bit of volatility, and I think we will see those Treasury yields jump above that 4.8% level, and I think you'll see stocks have another bad day. Kind of compensating for any bad stuff going on, as I was talking about, this has got to be a good earnings season. We have a slew of big US bank stocks reporting earnings tonight. They have a lot of good things going for them. We expect them to say good trading, improved investment banking, and of course, with the yield curve normalizing, meaning that longer-term rates are higher, than short-term rates, which always makes it easier to run a lending operation where you're getting your capital from deposits. Well, we expect banks to announce very strong earnings for the fourth quarter. Of course, the market expects it, but banks are very good at getting stuff done. I'm sure they'll outperform those expectations, and that will be a positive for the market tonight. But overall, this is where we stand going into tonight. If the CPI number is okay with the strong banks, we should have a good day tonight. But if we have a miss on that CPI, I think it could get a little bit ugly.